your budget, because as a loan officer, obviously I can, I can say mathematically, this is what you qualify for and all of those kind of things. And this is, your max sales price, max loan amount. But that's not really how we want to shop for homes, right? We want to make sure that we're buying within our budget and that it's something that's comfortable. And then what can we get for that? And then right size our expectations first, leading with whatever that monthly payment is. A lot of times for most loan scenarios, lenders are looking for, or the programs are looking for, around a mid 40% debt to income ratio. So what does that mean? That means whatever your monthly expenses are that report on your credit report. So student loans, cars, credit cards, the minimum payments, all of that stuff then is added to the mortgage payment. And then we divide that by your gross income, your before tax income. So as long as that number is somewhere in the 40s, you're usually good. There are some programs that go higher in debt to income ratio, but again, that's where we're talking about knowing your budget and what works, because we may need that higher debt to income ratio for the loan, knowing that there's extra household income from a second job or maybe a partner that's not on the loan. But first, we're leading with that payment because we know that works for your specific budget. So kind of specific budget and loan are two different things, but we want to try to get them as closely aligned as possible. What's really helpful is using something like MoneyMate that does allow you to, build up your accounts, to really have a good sense of your budget and to plan ahead, right? Because if you're paying, let's say, $2,000 for rent, and for, you think you're comfortable with $2,500 maybe for a mortgage payment, let's test drive that a little bit and make sure that that's comfortable for your budget, and make sure that you've got a good buffer, right? Because life happens, and even though you might have a fixed mortgage interest rate, meaning your mortgage payment isn't changing for the entirety of the loan, the principal and interest portion of your payment, because most loan types, because most homeowners have their property insurance and their property taxes included in their mortgage payment, and they're paying it, kind of spaced out over the year, those will change over time. Insurance costs are going up, taxes, when have we ever known that property taxes go down? So you want to make sure that
so glad you mentioned that, because a lot of people do think like their mortgage is going to be fixed. Like, you said my mortgage is going to be $1,400. Right. And they don't realize, like, when your tax and insurance go up, and it happens every year, and your escrow is paid out, you can end up with a shortfall, and they can adjust that mortgage payment.
Right. And so when you have buffer, and you've kind of test drove that mortgage payment using MoneyMate, that it fits. And I think that beyond just sort of like, good planning and all of those things, I think it really gives you a comfort and a confidence to take that next step, because buying a home is exciting, but it's also stressful. And having that information, I think, really lowers that stress, because you're like, I can do this. I can see in black and white that this fits in my budget. I know that I can do it. I know that I've got that emergency fund, and I can take this big step. And that makes buying a home more enjoyable versus kind of like white knuckling your way through. So once you understand what your budget is, the next step, sort of like I touched on, was to actually get officially pre-approved. And what that looks like is submitting an application. Most every lender has an online application, but you're submitting your application with your personal info, talking about your job history, what you make, where your accounts are, how much you have in checking, savings, 401ks, all those kind of things. And then a lender is going to look at that and look at your credit report and say, based off of your needs, based off of your preferences, based off your numbers, based off your credit score, all those things, these are either the type of loans that I would recommend, or this is the type of loan that I would recommend that you can get pre-approved for. And here's a key when you're looking for a loan officer is, and why, right? It's not just, oh, you're pre-approved and here's your amount. It's, why are you recommending this strategy? Why are you recommending this loan type? Because there is a customization factor of it. It's a complex process. So you want to make sure that what you're doing, just like when you're thinking about investing, you might think about different, funds or different types of investments to buy. It's the same thing with a mortgage. You want to make sure that it not just fits your goal of buying a house now, but it's going to work for you long term. Once you're pre-approved, then that's when you can start house hunting. So again, don't wait until you find something to get pre-approved. Get pre-approved early, work out the finances, and then go shopping. And it's important from the standpoint of being able to demonstrate to a seller when you're making an offer that you are pre-approved, right? We're not talking about a pre-approval that it's like click button, get mortgage. It's, I provided my pay stubs, my W-2s, my bank statements. A lender has looked at them specifically for me and says that I am pre-approved for this program. So it shows that you are a serious buyer, that you're a well-qualified buyer, and you are somebody that they can trust that by working with you and selling to you, it's, going to result in a closing. It's also helpful when you're thinking about pre-approved is really focusing on your needs versus wants, because it's very easy to walk into a house or a model home or whatever, and it's beautiful and it's all these things and you're like, I want it. But again, a home there is that emotional aspect of it's our home, but you want to make sure that it's a good logical decision, right? Like if you need a home office, that might mean you buy the home that has the home office, that has the functionality that you need, but maybe the kitchen cabinets are a little dated. That can be fixed with paint. It's very difficult and expensive to fix a floor plan or a location. So it's getting really drilled down to, this is what I have to have in this house that's going to make this a good decision for me. And here are the things that I would like to have, that I would love to have in a house versus what you absolutely need. Once you find a home that you love, then you're working with your realtor, you're making an offer, negotiating the price, when you're closing, how much you're providing in earnest money, and that's money that you're providing up front to say, yes, seller, I am serious about this, and I want you to take your house off the market so I can, do all my loan things, and we're moving forward towards closing. But that's where a realtor really comes into acting as your advisor, your fiduciary agent, from the standpoint of they are there advocating for you. Home inspection and appraisal. So once you're under contract, then that's when you're officially moving forward with the loan process, meaning we have a address, you're locking your interest rate. And two of the big things that happen are, other than underwriting, which is reviewing and approving your loan, are going to be getting a home inspection and an appraisal. And those are two separate things, because a home inspection is going to tell you, the buyer, this is the status of the home. These are any of maybe the outstanding maintenance things that would need to be done, anything just so you are aware of the condition of the home that you're buying in. And then an appraisal is going to, essentially, it does tell you as the buyer, but it's really done for the benefit of the lender to say, this home is worth what it's being sold for. Therefore, it's the right balance of kind of the asset versus the debt, the mortgage. And as long as it appraises for the sales price or more, you're good to go. If it appraises for less, then it really kind of depends on the individual situation of what that means for your loan and moving forward. But both of those are essentially just, it's to get information, be aware of what you're buying and being aware of what it's worth. So once that's done, once your underwriter, or once an underwriter has reviewed your file, said, yes, all this data, the numbers work, the income is the same as what you're pre-approved with, then that's when you're going to get your final approval. So people will call it a final approval. People will call it a clear to close. But what that means is you've got the money. Now you got to show up for closing. And what happens at closing is where you're bringing any outstanding money that's needed for down payment, for closing costs, and it's that final number as far as the funds that you're bringing to closing. You're going to sign the legal paperwork that's transferring the title from the seller's name into your name. Typically, it gets recorded that day. You're getting the keys and the house is yours. So another question, just kind of wrap all of that up, that people tend to ask is, that's great, when does my first payment start? So one thing to keep in mind when it comes to getting a mortgage is you must always skip a month before your first payments begin. And so what that looks like is, let's say that you closed in November, your first payment won't be until January 1st. And sometimes it's helpful to kind of know the timing of all of that if you're also trying to time up with the end of a lease. That was a sprint through the mortgage process.
Yeah, no, great. Amina, do you have any questions before we dive in, or before we cover anything else? I know we both kind of said a lot.
Yeah.
No, not at this time. Thanks.
Okay, great. Okay, so another thing that you touched on that I thought was really, really good was that inspection. So, I always tell people it's so important, sometimes people don't want to spend, anywhere from $500 to $750 for an inspection, because it's an added cost, it's something else, and it can be an expensive process. But it's almost like buying a car without looking underneath the hood, right? So you want to absolutely spend the money for an inspection, so that way you don't buy a home that you're going to end up with a bunch of problems and surprises with, right? So they're going to check for wood rot. They're going to check for, water stains, water leaks and stuff throughout the property. And just so many different things that you wouldn't even and expect. I had a friend of mine, when I was building this home, who is also a builder, come and help me with my inspection. And he was like, "Why is this pole here? What are they doing with this?" I was like, "I don't know." So I left with about 8 questions, and I was so glad that, I did my due diligence in terms of just having somebody else who, has an expert eye come in and kind of take a look at the property and pose these questions, so I could go back to the builder and ask them, like, why is there a window where my sink is over my vanity, because the mirror is supposed to go here? So those are like things that I would not have caught, and then they would have finished it and then been like, "Well, you didn't say anything when you came by," and that would have been a whole another fight or argument. So um definitely pay for the inspection. I know that, again, it's just another cost, but in the end, it's going to protect your interest, and it could save you a lot more money in the long run.
That's what I was going to say. Is it kind of like it's not just it's not just kind of like, oh well, maybe do it if you want to do it or not, because most loan types don't require it, right? It's not something that's required for your loan, but it is a good investment to protect yourself, because most of the time anything that's going to be uncovered that's going to be enough of kind of an issue, it can get expensive very quickly. So spending that $500 to protect yourself against a $4,000 repair later on, for example, is a really good ROI, on in my book. And I think to just kind of piggyback and sort of close that up with what you said is, even if you're getting new construction, even if it's a recent remodel and it looks perfect, still get an inspection. And if you are doing new construction, get inspections along the way, so you can see what's behind the wall. Make sure that the wiring is right. Make sure that the plumbing is right, because there are a lot of people working on a home, and everybody's doing their best. We hope, but everybody's doing their best. But everyone's human, so you want to make sure that once it becomes yours, that you're not kind of inheriting somebody else's issue.
Yeah, because I noticed, like, even in my home, they wired some of the rooms wrong. So electrical outlets are like in places that you wouldn't imagine. Like, why didn't you put it over here?
Oh
But,
yeah.
I digress. I
I
digress. It's
digress.
just one of
We
those
we can
things.
talk about that all day long, but yes, I have a couple bathrooms
Right.
that have a hot and cold switch, and I'm like, what are we doing here?
Right. Yep, exactly. So, okay, so beyond the closing process, there's different types of loan programs, and a lot of people don't realize, like, there are so many
Yeah.
different loan programs. And within the loan programs, they all have different requirements in terms of down payment, debt to income ratio, kind of like you touched on before. Some of them have just different thresholds all along. And another thing, as you were speaking, I was thinking of, I always tell people, just from my, past life, as I call it, being a home loan originator, is I tell people, once you get that pre-approval, that's like a snapshot. So don't change anything. So again, don't go buy a car. Don't go put
Yes.
in a trip on your credit card, because you were pre-approved based on where your finances were at that time. So your snapshot needs to look the same until you close on that loan. Otherwise, you could disqualify yourself from qualifying for that mortgage. So that's
Yep.
super important, and something that people need to know about as well.
Yes,
What are
basically
you
don't
seeing now?
no new debts, because that's a big one, right? And because honestly, like I just closed somebody on Monday that we started working together 9 months ago. And he's been looking this whole time. And so understand that if it takes a long time, that's okay. But just keep in mind, like you said, it's a snapshot. So if something changes, like new debt, changing a job, changing how you're paid, going from salary to 1099, contract type work, or what the money that you have for the down payment, if that changes, talk to your lender before putting in an offer, because we want to make sure. Sometimes it's not a big deal, sometimes it is, and you'd rather know before you're entering into a contract.
Yeah, and that's a good point. And that is not only applicable to debt, but that's to assets. So when it comes to like your down payment, you cannot have like a mysterious deposit of $5,000, because they have to source it. So you
Yes.
also don't want to do anything wild and crazy when it comes to like new deposits. So they have to source where those funds are coming from. Most lenders will look back 2 to 3 months at bank
Mhm.
statements to look at deposits, to make sure it's coming either from earned income, or if you're getting gift funds. And some mortgage programs allow gifts and some don't. So you need to make sure that you're talking to your loan officer about all those things and kind of what you've done to get yourself in the financial position to be able to qualify for this home as well. So that way something related to the assets that you're using doesn't also disqualify you. So
And that, yeah, I think that's, it's not like we're not there trying to be big brother, like, what'd you do now? Right. But it's more from just the standpoint, we want to be able to work together, right? Because a lot of times, whatever the situation is, if we have a little bit of time, if you aren't under contract and it doesn't pop up as a surprise, we can pivot. We can look at a different loan type. We can figure out a different option, but we just need to know, right? And I think sometimes people are like, oh, well, I don't want to tell my loan officer because I don't want to hurt my chances. Well, I mean, I'll just tell you frankly, I mean, loan officers, we don't get paid unless you close. So, we want to find a way to make it work. We are on your side. And from a more, empathetic kind of altruistic standpoint, we just don't want you to get backed into a corner with a situation that could have been avoided with a little bit more time or just a little bit more, kind of heads up.
yeah, because those underwriters find out everything.
They will. Yeah. I mean, that's the thing is they're like, also, please just don't lie because we're going to find out. I mean, like, there's so many checks and balances. I feel like after 2008 that like whatever is happening, it will come up. But we just don't want it to have to be a surprise mid-process because then it starts to get messy.
Right, absolutely. Okay, cool. Well, thanks for sharing that. So, can you go over for us like a few of the popular mortgage programs? If somebody say, wants to also, like you said, buy a home, they found one in their budget, but it's not something that they absolutely love, or maybe there's some renovations or repairs and things like that that they want to do to the home to make it perfect for them.
Absolutely. So for the majority of home buyers, you're going to have one of four loan types. So there are jumbo loans for homes that are, over 800, 900 in most areas of the country. But for most people, they're working with one of four loan types. So the first one that people know a lot about or have heard is conventional. Conventional is kind of your standard, what you think of with a mortgage loan. It's 30 years. As a first-time home buyer, you can put as little as 3% down. 20% is another threshold from the standpoint as far as you don't have mortgage insurance, which is an extra payment that's included in your mortgage payment if you're putting less than 20% down. But most people fall somewhere in kind of that 5 to 10% down range, because I think a lot of people, particularly, right now are like, hey, maybe I could put 20% down, but I could put less than that, keep some more money aside for emergencies, keep that buffer. And because only about an extra 10,000 down on your mortgage only lowers your payment by about $70. So if you're buying within your budget, you're comfortable with the payment. Sometimes people like to have that buffer. So conventional 30-year fixed, anywhere between 3 to 20%. The minimum credit score is 620. Most of the time, conventional makes sense if your credit score is in the higher 600s or over 700, just because conventional is much more credit score sensitive when it comes to what the rate and what the mortgage insurance would be. The second most popular after that is FHA. FHA has a minimum down payment of 3.5%, as long as your credit score is 580 or more. If it's 500 to 580, minimum down payment is 10%. FHA does have mortgage insurance included for the life of the loan. But again, most people typically don't keep their mortgage, for 30 years. So sometimes that can kind of be a means to an end, understanding that you could refinance out of that FHA later. And my stance on that is PMI is not a four-letter word, because it's a way to leverage and kind of get on that train, of real estate and start to earn equity, which then sets you up for other choices later. FHA is a great choice.
Can I ask you a question about that?
Yeah.
So with the FHA, can you still avoid PMI if you put down over 11%, or has that gone away?
So it will, you don't avoid it, but it can be removed.
Okay, but you have to put down that 11% in order for it to fall off once you've reached what, 80% loan to value?
78% loan to value.
78. Okay.
Yeah.
Okay. Yeah. Thanks. I was wondering if that was still a thing.
Yeah, it is still a thing. I don't have a lot of people that go that route, because a lot of times kind of if they're at that down payment, then we're doing something else with conventional, but it is there as an option. And
Gotcha.
FHA, one of the other appeals for FHA is one of two things, is that it's a little bit more, kind of past credit issue friendly. So if you have a past bankruptcy, if you have some lates, And as you're repairing your credit, you might be kind of like, I've done so much work, but I don't feel like I'm all the way there. FHA can
Yeah,
be a
that's
good
what I
way
was thinking about.
yeah, it's still a
Yeah,
30-year
I was
fixed
thinking
loan.
about
It is still a
like the
very solid
people that,
loan.
yeah, I was thinking about the people that might be credit challenged, because I know also with like conventionals, you can't have late payments within a certain amount of time. So maybe from a credit standpoint, they can't qualify for conventional. They can absolutely still go FHA. But, if you were trying to avoid PMI, I just wanted to, definitely share like that's an option with the stronger down payment.
Absolutely. The behind that kind of split is a little bit between VA and USDA. So VA loans are only for veterans, active duty, or surviving spouses. It's one of my favorite loan types. It is so underutilized by veterans. So it's one of the best benefits that's available. It's actually how I was able to buy my first home. So I'm very pro, pro VA and all of that. You don't have to put a down payment. It is 100% loan. The rates tend to be better on a VA than conventional. There's no PMI, so there's no monthly mortgage insurance. Unless you have a service-related disability rating, then you have what's called a funding fee, and that's essentially how the VA program kind of funds itself. But that is a percentage of the loan amount that is financed back into the loan amount. So it's kind of like VA's version of PMI. But there's so many advantages and a lot of common sense underwriting when it comes to VA loans. So that's why I'm very pro VA. And unfortunately, there's a fair amount of misinformation and just kind of misunderstanding or bias in a lot of real estate markets about VA, which are mostly unfounded. Coming behind that would then be USDA. USDA, it's not just the people that certify our meat and cheese, but they do offer 100% loan as well. It is meant for more rural areas, but I always tell people you might be surprised because there's certainly some areas here around Charlotte. I know that there are some around Atlanta that are most definitely not rural, right? Like we've got a Target. It's not rural.
Yeah, very cool. Because I know, like in the Atlanta
Yeah.
area, like this area, Hiram and Dallas, it's country, but it's
Yeah.
growing like wildfire. So if you're
Yeah.
looking for an area where you're gonna be able to get a lot of equity in a short period of time, maybe that's a great loan for you to consider. It might be further away from a city, but the long-term benefits of growing equity quickly in an area that's growing, that might be a great option.
Absolutely. Absolutely. Because, USDA, it is restricted to certain areas. So there are maps that we check and there are some income limits. But it is worth looking at for sure because it's a great loan. And sometimes my take on that is like, hey, yes, you do have the money for a down payment, but again, you can always put that money on your mortgage later if you want to. It's probably not going to make a huge difference in your payment. And as long as you're comfortable with the payment, that may give you, more money to set aside for emergency funds, or it can set more money aside for improvements to the home, right? Like if you want to put in a fence, if you want to upgrade the home and things like that. And then sort of last thing is that there are down payment assistance programs available both for conventional loans and FHA, depending on, different borrower criteria. And under each of those loan types, there are also renovation loan options as well. So a lot of times what we're seeing right now too in the marketplace is sellers are like, Mark, I know that there's not a lot of supply, so I don't really have to do a lot to this home. I'm just going to put it up on the market. Well, plenty of people will overlook that because they want a move-in ready house. But if that's something that that appeals to you or something that you want to do, using a renovation loan can be a great way to, get a home for a good deal because maybe it has been overlooked because of the condition, but then you're able to finance those repairs into the loan that allows you to, make it the way that you want, or even just make some deferred maintenance repairs like to the roof or the windows or things like that.
Yeah, and then I'm always looking at ways to increase equity, so that's a great way to do it too.
Exactly. It's like a cheat code.
Yeah, exactly. Awesome. So I did have, a couple questions for you.
Mhm.
And you covered some of them. So we kind of went over the major differences and qualification requirements between a conventional FHA loan. So what is MIP?
So
Is that the
am I
same as PMI or is that something different?
It's similar but different. So they're kind of cousins. So PMI that most people are familiar with stands for private mortgage insurance. And that specifically means mortgage insurance that's tied to a conventional loan, because there are private mortgage insurance companies that provide that coverage. So just like we have homeowners insurance companies like Nationwide and State Farm and all of that, there are companies that only provide mortgage insurance for lenders to then pair up with a loan. So that's where the private aspect comes in, because they are most of the time private companies. But what MIP is mortgage insurance premium. So we're just moving the letters around. But it's mortgage insurance premium, and that is attached to FHA loans. So FHA loans, their particular mortgage insurance is referred to as MIP, because there's a two-part component. You pay a portion of it monthly, and then there's what's called UFMIP, which is upfront mortgage insurance premium. And that's a percentage of the loan that is rolled back into the loan. It is financed back into the loan. And that's how the mortgage insurance on FHA is split into two parts.
Gotcha. Okay. Okay. And when it comes to like the renovation loans that we touched on, what are some situations where like a FHA 203K loan would be more beneficial than like a standard mortgage?
Most of the time it's going to be a factor of which loan type is ultimately best, right? So do you qualify for conventional, or is FHA a better bet? Because there's not a ton of difference between conventional and FHA renovation loans. There's some small differences, because there's actually two ways that you can go about using an FHA renovation loan, which is called a 203K. Pretty much the conventional, it's kind of, these are the rules. The only other difference would be if, depending on the property, if there's some of the things, maybe there's structural issues, or perhaps there might be some water remediation, things like that. So there are some nuances that the property could affect which loan type is best, but usually it's going to be the borrower and what loan type, whether conventional or FHA, fits them.
Gotcha. Okay. Um, now I know that another thing that, loan officers also kind of tackle is refinancing, right?
Mhm.
So, how do you kind of guide people, or what tips do you give them when they're trying to determine, like, okay, I have a new deck I want to put in, or maybe they bought a home and the basement's not finished? How do you kind of guide them in terms of like, is an equity product like a loan or a line of credit better, or should they do a cash out refinance and just wrap it all into one loan?
So usually what we're doing is a side by side, because it could be, let's say that somebody bought a few years ago and they've got a 3.75 rate, right? And they're like, I have to hold on to this 3.75 rate, and I am all for that because it is historical. We're probably not going to see it again. I get it. But depending on what their goals are for tapping into that equity and how much money they need, sometimes a cash out refinance, yes, even if it's a higher rate, could make sense, because sometimes people are, maybe paying off high interest credit cards, or maybe they did the renovation already, they put it on credit cards, and now they want to right size that. Overall, your debt load is going to be less, even if the interest rate on the mortgage is higher. And that's where sometimes that could make sense of doing a mortgage over a, say, home equity line of credit. The home equity line of credit is always going to have I shouldn't say always, the majority of times, to be compliant, the majority of times, a home equity line of credit, a second mortgage on your home, is going to have a higher rate, because it's sort of like a credit card that is tied to your property. And so it sort of splits the difference between whatever, regular purchase rate, rates are doing right now, and where credit card rates are. It's kind of there almost in the middle. That can make sense when someone maybe, wants kind of an infusion of cash because they, want to tap into that equity to maybe buy another property. They can use that down payment, kind of use the equity in this property to purchase another one. But they know that they're going to be paying that balance down, because as you pay the balance down on a HELOC, your monthly payment is less. It may make sense because taking a higher rate on a new mortgage, does create a higher payment than even what their current mortgage is, and that HELOC payment, even though it's at a higher rate. So a lot of it comes down to not just kind of, can you do it or not, or does the math work? It's more, does it work for that person, for the goals that they have, and frankly, sometimes for the comfort level, because sometimes people are like, I don't like that a HELOC has a variable rate. That doesn't make me feel comfortable.
Yeah.
That's a valid enough reason to not do it, and
Yes,
try to
yes,
find
because
another solution. Yeah.
rates are definitely enough to make you nervous right now. So speaking of rates, right? So outside of a renovation, people are always trying to figure out like rates are high. Should I buy now? Should I wait? That was a decision that I had to come to. I bought my second home in 2008, which was a lovely time to buy from a pricing standpoint, but from an
Hmm.
interest rate standpoint, and it was a nightmare. I had a 6.875 interest rate with a perfect credit score, but I still had a
Yeah.
crazy high interest rate. And, I had to make the decision that, okay, I have a great purchase price, crazy high interest rate. I was still going to buy anyway, because again, it was, adding to my journey of building equity, building on to, creating a foundation to build wealth for myself. But the interest rate kind of ate me up, right? And so interest rates later dropped. 4 years in, I refinanced. I got a 3.25% interest rate at that time. But there's a whole analysis that you need to do when it comes to understand like your break even, right? And
Hmm.
maybe you're 10 years into a mortgage. Maybe, you need to reduce the term if you are going to refinance and not do another 30-year term.
Hmm.
Maybe you need to be looking at a 20-year or 15-year. Can you kind of talk to us a bit about how somebody should make that decision to see like if a refinance to reduce their rate later once the rates go down makes sense?
Yeah, a lot of times, how we're looking at that is basically what the recoupment period is from the standpoint of, because when you're refinancing, it is a new mortgage, whether you're doing it with, an outside company or you're doing it with the company that currently has your mortgage. Regardless, it's a new mortgage. There are loan fees. There's no such thing as a free refi. It's just marketing. But what you want to look at is what is that mortgage going to cost you? Also keeping in mind that you do typically skip a month's worth of payments, and if you have an escrow account for your taxes and insurance, that gets returned to you as well. So once you kind of, realize what those closing costs are, what's maybe coming back in the sense of skipping the mortgage payment, getting the escrow, what is that difference? What is that kind of net cost for that refinance? And then if you are dropping your rate, then how much is that saving you per month? Take the cost, divide it by the monthly savings. That tells you how many months it takes for recoupment. That's super easy when we're just refinance basically to drop the rate. Once you get into stuff like cash out and maybe we are paying off debt, or maybe you're improving your home, that does get a little bit more of kind of that fuzzy sort of ROI from the standpoint of, ultimately my payment's going up, but maybe I'm finishing my basement and that's giving me an extra 30,000 or 40,000 in equity. Well, that to me would probably be worth a couple extra hundred a month to, to kind of, it's almost kind of like a different investment that you're making, because you're, improving that equity position that you'll cash in later when you sell. From the standpoint, as far as going from a longer term to maybe like a shorter term, but also a lower rate, you're paying, you might not save any a month. You might even go up a little bit in your month because you're shortening the term. But then that's getting into, but how much faster are we going to be paying off this mortgage? You might not feel the savings right now, but how many tens of thousands in interest are you going to be saving over the next couple of years?
Yeah, because that's always my concern is like if you have a 30-year, you're 5 years in and you stretch it back out to, another 30-year, now you've lost all the interest. You're not going to
Yeah,
lose the principal, but you paid interest all that time. So you do take a hit right there. And, I always tell people that's a part of looking at the total cost as
right.
well to see if that opportunity cost makes the most sense.
And that's where it's helpful to, to be able to look beyond just the payment, right? So if we're, 5 years into a 30-year mortgage, somebody wants to refinance, maybe they're saving a little bit of money, which is great, but they're, certainly saving on the interest. It's like, how do you not totally reset the clock? So there are 25-year loans or 20-year loans, or sometimes, again, that's why it's called personal finance, because it depends on what works for the person. But
Right,
sometimes it
right.
might be taking that 30-year mortgage, but having, the discipline, just like building a budget, of paying extra towards the principal, right? Because you can always pay more towards a mortgage
So
and shorten
smart.
the term. And then
So
you still
smart
have that
without
flexibility in the budget.
refinancing.
Yeah. Because it could be
Yep.
like, I've had people that maybe dropped their maybe they drop their payment about $400. $400 is great. But if they keep putting, say, 200 extra on the mortgage, then they're not really losing that much time, because we can kind of run the amortization, run the schedule of what the balance is going to be 5 years out with their existing mortgage, run the balance on what it's going to be on the new mortgage with or without extra payments. And then we'll be able to sort of project ahead where it's going to be, to make sure that they aren't backtracking for kind of like short-term gains. And then it just depends on what works for them. Or, I mean, what I've done when I refinance is, yes, I've got a lower rate, but I've already built in that mortgage payment to my budget. So I just keep paying it as before. But what I'm
Right,
doing is,
smart.
yes, I'm saving interest because of the lower rate, but I'm also kind of accelerating that, building up that equity, because I'm also now paying extra on the principal, and it's net neutral to my budget.
Right, so smart. Well, this session has been so awesome. So
Thank
I
you.
want to just thank you for joining us today and helping us with this home buying workshop that we did today. So everybody, Rebecca and I are here to answer all of your questions. So feel free to ask away. I'm going to put our contact information in the YouTube video. Don't forget, MoneyMate is here to support you with your financial planning tools that can help you to reach your goals. So whether you're buying your first home or just simply wanting to improve how you're managing your cash flow, check it out. And we'll see you next month for the next session. Thank you, Rebecca.
Thank you.
All righty. Bye-bye.